Welcome to the ultimate guide for turning a significant starting sum $1,5 into a powerful engine for your financial future. If you're reading this in 2025, you've likely worked hard to save this money, and the thought of investing it might feel both exciting and incredibly daunting. The world of finance is filled with jargon, conflicting advice, and scary headlines about market crashes. It's enough to make anyone want to hide their cash under a mattress. But here's the good news. Investing has never been more accessible, and you don't need a finance degree or a Wall Street salary to do it successfully. That $1,500 is more than just cash. It's a seed, planted correctly and nurtured with patience. It can grow into a formidable tree of wealth that provides for you for decades to come. This guide is designed to be your friendly, no-nonsense manual, inspired by the practical, down-to-earth advice you'd hear on the best finance shows. We'll cut through the noise, demystify the process, and give you a clear, actionable roadmap. We'll cover the essential groundwork you must do before investing, the different vehicles you can use, the specific assets you can buy, and the golden rules for long-term success. By the end of this article, you won't just have a plan for your $1,500. You'll have the confidence and knowledge to begin your journey as a lifelong investor. Let's get started. Part 1. The foundation. What to do before you invest a single dollar. Jumping straight into buying stocks without laying the proper groundwork is like building a house without a foundation. It might look good for a little while, but it's destined to crumble. The smartest investors know that financial health starts long before you open a brokerage account. Best Finance Show tip number 1. Tame the dragon of high-interest debt. Before you even think about earning a 7 to 10% average annual return in the stock market, you must address any debts that are costing you 15%, 20%, or even 25% per year. We're talking about the most destructive kinds of debt, credit card debt. This is the number one wealth killer. The average credit card interest rate can easily top 20%. Paying off a credit card with a 22% APR is the equivalent of getting a guaranteed tax-free 22% return on your money. No investment in the world can safely and reliably promise you that. Payday loans and personal loans with high rates. These are financial emergencies, not tools. Their interest rates are often astronomical. Your action plan. If you have this type of debt, the best use for your $1,500 is to make a massive payment against your highest interest balance. It might not feel as exciting as buying a piece of a tech company, but it is, without a doubt, the single best financial move you can make. It's a guaranteed win. Note, lower interest debt, like a mortgage, federal student loans, or a reasonable car loan, is different. You don't necessarily need to pay these off before investing, as their interest rates are often lower than the potential long-term returns of the market. Best Finance Show tip number 2. Build your financial moat. The emergency fund life is unpredictable. In 2025, we're all acutely aware of how quickly things can change. A car breaks down, a medical issue arises, or a job loss occurs. An emergency fund is a pool of cash, separate from your investments, designed to cover these unexpected expenses. Why is this so critical? Without an emergency fund, a $1,200 car repair bill would force you to do one of two things: go into high-interest debt, see tip number 1, or sell your investments to cover the cost. Imagine you invested your $1,500. The market temporarily drops by 20%, and then your car breaks down. You'd be forced to sell your investments at a loss, locking in that loss forever. Your emergency fund is the moat around your financial castle. It protects your long-term investments from short-term life events. Your action plan. The standard advice is to have 3 to 6 months' worth of essential living expenses saved. If you're just starting, that goal can feel impossible. Use your $1,500 to kickstart this fund. Open a separate high-yield savings account, HYSA, more on this later, and deposit the money there. Label it emergency, do not touch. This single step provides incredible peace of mind and is a non-negotiable pillar of financial stability. Best Finance Show tip number 3. Define your why, goals, and time. Horizon investing without a goal is like driving without a destination. You'll burn a lot of fuel and end up nowhere in particular. Your investing strategy should be tailored to what you're saving for. Ask yourself, what is this $1,500 for? Short-term goal, 1-3 years. A down payment on a car, a wedding, a big vacation. Mid-term goal, 3 to 10 years, a down payment on a house, starting a business. Long-term goal, 10 plus years, retirement, financial independence, leaving a legacy for your children. Your time horizon, the length of time until you need the money's the single most important factor in determining how much risk you should take. Long time horizon. You have decades to ride out the market's ups and downs. You can afford to take on more risk by investing more in stocks for the potential of higher returns. Short time horizon. You need the money soon and can't afford for it to lose value. You must be much more conservative by keeping it in safer assets like cash or bonds. You would never invest money you need for a house down payment next year in the stock market. Your action plan. Take 15 minutes with a pen and paper. Write down your top 1 to 3 financial goals and assign a time horizon to each. This clarity will be your compass as you choose your investments. For most beginners investing their first $1,500, the best goal is a long-term one, like retirement, as it unlocks the most powerful force in finance, compounding. Part 2. The how. Setting up your investment account. Okay, you've paid down your toxic debt, you have an emergency fund started, and you've defined your goals. Now, it's time to open the door to the market. You need a place to buy and hold your investments, which is called a brokerage account. Choosing your brokerage. Think of a brokerage as a department store for investments. It's where you go to buy stocks, funds, and other assets. In 2025, you have a wealth of fantastic low-cost, user-friendly options. Here's what to look for. $0 commission fees. You should not have to pay a fee to buy or sell US stocks and ETFs. This is the industry standard now. No account minimums. You should be able to open an account with $0 fractional shares. This is a game changer for new investors. It allows you to buy a slice of a stock instead of the whole share. If a share of a company costs $500, you can invest just $50 and own 0.1 shares. This lets you build a diversified portfolio, even with a small amount of money. User-friendly interface. The mobile app and website should be clean, simple, and easy to navigate. Reputable options include Fidelity, Vanguard, and Charles Schwab. These are industry giants with long track records. Newer platforms like M1 Finance and Public also offer compelling features. Types of investment accounts. This is a crucial choice. The wrapper you put your investments in can have massive tax implications down the road. The default. A taxable brokerage account. What it is. A standard general-purpose investment account. How it works. You deposit after-tax money. When you sell an investment for a profit, you pay capital gains tax. You also pay taxes on any dividends you receive each year. Pros. Highly flexible. You can withdraw your money at any time for any reason. No contribution limits. Cons. Less tax efficient. The taxes can create a drag on your long-term returns. The superstar for beginners. A Roth IRA. What it is. An individual retirement arrangement IRA with incredible tax benefits. How it works. You contribute after-tax money just like a taxable account. Here's the magic. Your investments grow completely tax-free, and all your qualified withdrawals in retirement are also completely tax-free. Pros. This is the most powerful tax advantage a young investor can get. You pay taxes now, likely while you're in a lower tax bracket, and never again. Cons. It's a retirement account, so there are penalties for withdrawing earnings before age 59.5, though you can withdraw your original contributions tax and penalty-free at any time. There are also annual contribution limits for 2025. Let's assume it's around $7,000, but check the official IRS limit and income limitations to be eligible to contribute. Which should you choose? For a beginner with a long time horizon, a Roth IRA is almost always the superior choice for your first $1,500. The long-term tax savings are simply too good to pass up. If you've already maxed out your IRA or need the money for a midterm goal, then a taxable brokerage account is the way to go. Part 3. The what? The best investment options for your $1,500. This is the moment you've been waiting for. You have your account open and funded. What do you actually buy? Here are the best options for a beginner, from simplest to slightly more complex. Option 1. The king of simplicity. Low-cost index funds, ETFs. If you only take one piece of investment advice from this entire article, let it be this: buy a low-cost, broad market index fund. What it is. An index fund is a type of mutual fund or exchange-traded fund, ETF, that doesn't try to pick winning stocks. Instead, it simply aims to own all the stocks in a particular market index and match its performance. The most famous index is the S&P 500, which represents the 500 largest public companies in the United States. The analogy, trying to find the next big stock, is like trying to find a needle in a haystack. An index fund simply buys the entire haystack. By doing so, you are guaranteed to own all the winners like Apple, Microsoft, Amazon, while diversifying away the risk of any single company failing. Why it's perfect for beginners: instant diversification with one purchase. You can own small pieces of hundreds or even thousands of companies. Your $1,500 is immediately spread out, dramatically reducing your risk. Extremely low cost, because they are passively managed. Their fees, called expense ratios, are incredibly low, often 0.04% or less. This means more of your money stays working for you. Proven performance. Historically, the vast majority of professional, active fund managers failed to beat the performance of a simple S&P 500 index fund over the long run. Your action plan: the classic portfolio. Choose your index. For most U.S. investors, a great starting point is either an S&P 500 index fund or a total U.S. stock market index fund. Find the ETF ticker. Every ETF has a stock-like ticker symbol. S&P 500 ETFs, VU Vanguard, IVV, iShares BlackRock, SPY State Street, total U.S. stock market ETFs, VTI Vanguard, ITOT iShares, BlackRock. Invest your full $1,500. Put the entire amount into one of these funds. That's it. You are now more diversified and have a better long-term strategy than of people who try to pick stocks. For a bit more global diversification, you could put 80% $1,200 into a U.S. fund like VTI and 20% $300 into a total international stock market ETF like VX US Vanguard. Option 2. The automated approach. Robo-advisor. Even the idea of picking an ETF feels like too much. A robo-advisor might be the perfect fit. What it is: a robo-advisor is an online service that uses algorithms to build and manage a diversified portfolio for you. How it works: you sign up and answer a questionnaire about your financial goals, time horizon, and risk tolerance. Based on your answers, the service automatically invests your money into a portfolio of low-cost ETFs, usually a mix of stock and bond funds. It also handles things like rebalancing and dividend reinvesting for you. Pros: completely hands-off, professionally designed portfolios. Great for people who want to set it and forget it without any guesswork. Cons: you pay a small annual management fee for the service, typically around 0.25% of your assets. This is on top of the underlying ETF fees. While low, it's more expensive than buying the ETFs yourself. Popular options: Betterment, Wealthfront. Your action plan. If you value convenience above all else and are willing to pay a small premium for it, open an account with a reputable robo-advisor, complete the questionnaire, and deposit your $1,500. The machine will take it from there. Option 3. The learning by doing approach. Individual stocks with caution. Many beginners are drawn to investing because they want to buy shares in companies they know and love, like Apple, Amazon, or Tesla. What it is: buying a stock or an equity means you are buying a small piece of ownership in a single company. If the company does well, the value of your stock can go up significantly. If it does poorly, it can go down, even to zero. The big warning: putting all your $1,500 into one or two stocks is extremely risky. It is the opposite of diversification. While the potential for a huge gain exists, so does the potential for a huge loss. The power of fractional shares. As mentioned earlier, you no longer need thousands of dollars to buy expensive stocks. With fractional shares, you can invest as little as $1 into any company. A responsible action plan for the curious beginner. This is a strategy to satisfy your curiosity while still being smart with the majority of your money. Anchor your portfolio in an index fund. Put the bulk of your money, say 80 to 90%, $1,200, $1,350, into a broad market ETF, like VTI or VOO. This is your safe, stable foundation. Use the rest as learning money. Take the remaining 10 to 20%, $150, $300, and use it to buy fractional shares of 2 to 4 individual companies. Invest in what you know. Don't buy a biotech stock you don't understand. Buy a small piece of a company whose products you use, whose business model you believe in, and whose future you feel optimistic about. Do your homework first. Read their investor relations page. Treat it as a learning experience. This small part of your portfolio is your tuition. It will teach you about the volatility and psychology of owning individual stocks without putting your entire investment at risk. Option 4. The Safe Harbor High Yield Savings Accounts, HYSAs. Wait, isn't this a guide about investing? Yes, but, as we saw in part 1, sometimes the smartest move isn't to take market risk. What it is, a HYSA, is a savings account, typically offered by online banks, that pays a much higher interest rate than the paltry 0.01% you might get at a traditional brick-and-mortar bank. In the economic environment of 2025, HYSAs can offer very competitive rates, sometimes exceeding the rate of inflation. Why it's a great option: zero risk. Your money is FDIC insured up to $250,000, meaning you cannot lose your principal. Liquidity: you can access your money whenever you need it. Solid return for cash. It provides a safe, predictable return. Your action plan: a HYSA is the perfect home for your money. If it's your emergency fund, you are saving for a short-term goal, 1 to 3 years. You are extremely risk-averse, and the thought of any market fluctuation keeps you up at night. Part 4. The Best Finance Show Golden Rules for Long-Term Success Investing. Your first $1,500 is a fantastic start, but building real, lasting wealth comes from developing good habits that you stick with for decades. Golden Rule number 1. Automate everything. The single most powerful habit is to set up automatic contributions. Decide on an amount you can afford to invest every week, 2 weeks, or month, even if it's just $25, and have it automatically transferred from your checking account to your investment account. This is called dollar cost averaging, DCA. It forces you to be consistent, removes emotion from the equation, and ensures you're buying both when the market is high and when it's low. Golden Rule number 2. Think in decades, not days. The stock market is volatile in the short term. There will be scary headlines and red days. Panicking and selling is the number one mistake investors make. You must zoom out. The stock market has historically always gone up over long periods. Your job is to ignore the daily noise and stay invested for the long haul. Golden Rule number 3. Keep fees. Low fees are a cancer on your portfolio. A 1% fee might sound small, but over 30 years, it can consume nearly a third of your potential returns due to lost compounding. This is why low-cost index funds with expense ratios under 0.10% are so highly recommended. Golden Rule number 4. Reinvest your dividends. Many stocks and funds pay out dividends, which are small cash payments to shareholders. Most brokerages allow you to automatically reinvest these dividends to buy more shares of the same investment. This creates a snowball effect that dramatically accelerates your portfolio's growth over time. Always turn this feature on. Golden Rule number 5. Keep learning. Your financial education didn't end with this article. It's just beginning. Read a few classic investing books. The Simple Path to Wealth by J.L. Collins is a must-read for beginners. Listen to reputable finance podcasts. Stay curious. The more you learn, the more confident you'll become. Conclusion: your journey starts now. Let's bring it all together. Investing $1,500 in 2025 is an achievable and incredibly wise goal. You don't need to be a genius. You just need a plan and the discipline to stick to it. Your 5-step action plan: build your foundation, assess your debt, and start an emergency fund. Your $1,500 might be best used here first. Define your goal. For most, this will be a long-term retirement goal. Making a Roth IRA the ideal account. Open your account. Choose a reputable brokerage like Fidelity, Vanguard, or Schwab. Make your first investment. For the vast majority of beginners, putting the entire $1,500 into a single, broad market index fund ETF like VTI or VU is the simplest, most effective strategy. Automate and be patient. Set up recurring contributions, no matter how small, and commit to leaving your investment alone for years, even decades. The hardest part of any journey is the first step. By reading this guide, you've already taken it. You've armed yourself with knowledge and a clear path forward. That $1,500 is your ticket to participating in the long-term growth of the global economy. It's your first major step toward building a future of financial security and freedom. Don't wait, start today. Your future self will thank you for it.